Swayam Prabha. Digital India. Educated India.
Mortgage calculations and amortization. This is the topic for today in course Real Estate Finance and Investment Strategies. So, first we'll look at the learning objectives of this particular class. Calculate basic mortgage payments using standard formulas. Understand the conceptual framework of amortization. Construct simple amortization schedules. Analyze the impact of prepayment on loan terms and apply these concepts in real estate investment decisions. So, building on lecture 11, in our residential mortgage products session, we explore various mortgage types such as fixed rate, adjustable rate, and PMAY loan, and saw EMI examples like one example we saw of for a 50 lakh loan at 8%, which was translating into a EMI of around 42,000 rupees. So, we also discuss prepayment rules such as no penalties for ARMs. Today's focus deepen our understanding of mortgage payments are calculated, how they are calculated, and how amortization builds equity, and how prepayment save time and money with practical tools and investment applications. Key concept to remember: EMI variability, loan to value ratios, tax benefits, and the importance of total cost analysis. So, first we will talk about a standard monthly payment calculation, PMT. So, let me present the mortgage payment formula that governs every home loan in index or in India, and PMT is equal to P into R into 1 plus R to the power n bracket close uh, divide by bracket 1 plus R to the power n minus 1, where PMT is monthly payment amount, P is your principal loan amount, R monthly interest rate, and that is annual rate divided by 12, and that is total number of payment years into 12. We have seen this formula earlier when we referred to it as EMI formula, and in previous session that time we saw that it is a famous formula. This formula is something which we use to calculate the EMIs. Now, we will talk about a scenario where we are looking at this particular example of 75 lakhs property value with a 15 lakh down payment. So, 60 lakh is your principal amount, and this interest rate is 8.5% per annum. So, that translates to per month, that translates to this 0.007083, and then one common mistake we have seen that sometimes by mistake annual rate is taken directly, and we have to remember that first it has to be converted into monthly rate, and then number of payments is equal to the monthly rate into 12. So, that 15 into 12 180. So, 180 we have to take for the this basically, and then we utilize the formula and calculate, which is resulting in the EMI value. So, basically this is how this will be calculated. So, then we come to understanding the payment components. So, we have beginning balance of 60,000, and then we go to the basically the interest portion, that is 42,498, and then principal portion of 16,596. So, basically this is what we are trying to do here. Now, key observation is that 72% of the payment covers interest, and only 28% reduces the loan, typical for your 15 years loan in India. So, that is the kind of we can see. We also briefly noted these EMI components earlier, but we are trying to quantify them to reveal the payment dynamics. So, for example, Mumbai borrower sees this high interest early impacting the cash flow. This split explains why early years feel slow in building ownership compared to any city loan which you will be talking about at 9%. So, higher rate means even more interest initially. So, that is the case. Then we come to the concept of amortization. So, amortization is the systematic process where each payment remains identical, but the interest portion decreases over time. So, the principal portion increases and the total debt reaches 0 by the loan's end. So, visualize it as a seesaw. That will be the best visualization. As interest fall, principal rises, building equity. So, for our 60 lakh loan, early payment are interest heavy, but by year 15, most go to principal, aligned with Indian borrowers' goal of debt-free relationship. In the introduction of mortgage, we introduced EMIs as fixed payment. There we focused on the internal shift, crucial for understanding loan progression. For example, a Jaipur home buyer sees slow equity growth initially, but faster later. So, this process ensures predictable budgeting, vital in India's high rate market. So, that kind of thing we have to see. Then let us take this sample amortization schedule. So, here we can see that in month 1 payment of 59,094, interest is 42,498, principal is 16,596, and balance is this 59,000 which is 59 lakhs 83,404, which is remaining. And then month 2 interest drops, we can see that it is 42,308, 380, and the principal amount is also dropping, is increasing, and that is how the trajectory is going on. In third month, we see that it is interest is going down a little more, 42,262, and the principal amount is 16,832. So, that is the gradual trend is of interest going down and principal increasing. So, that is how it will progress, and we can see that interest decreases by around 120 each month, and principal is increasing accordingly. Then amortization journey in 3 phases. So, phase 1 we can see year 1 to 5 interest heavy, 70 to 50% of payment goes to interest, with 2 to 3 lakh principal paid annually, offering high tax deduction under section 24B, as we had noted in earlier lecture. Phase 2 is year 6 to 10, transitions of 50 to 30% payment goes to interest, 3 to 4 lakhs principal, and then balancing payments. Phase 3 is year 11 to 15, is principal heavy, 30 uh, the 0% of payment goes to interest, and 4 lakh plus is to principal, rapidly reducing the debt. So, for our 60 lakh loan, equity accelerates in phase 3, aligning with Indian preference for shorter terms. In lecture which we discussed earlier, we discussed tax benefits. Here what we are trying to do is that we are trying to tie them with amortization phases. So, for example, Mumbai flat owner maximizes deduction time, maximizes your deductions early, and that is, uh, that is how the approach will be for many flat owners. Then coming to total cost analysis. So, let's zoom out to the loan's full cost. For our 60 lakh 15-year loan at 8.5%, the monthly payment is 59,094. Total payment is 59,094 into 180. That values this, and the total interest is coming somewhere after we are subtracting from the total amount this much principal amount, the loan amount, then we get this the 46, around 46 lakhs is the total interest we are paying. So, interest equals 77% of the principal, lower than 20 to 25-year loan due to the shorter tenure. So, a key insight for Indian borrowers seeking affordability is that you try to do this. So, in earlier lecture, a 50 lakh loan which was given at 9% at around 58 lakh interest. This 60 lakh case is at 8.5, provides a new angle. Okay, avoiding the the same case, but we are trying to do a little different, and this is also showing that how the interest is paid, and that is how the EMI distribution is. So, for example, a Bangalore borrower pays 46 lakh interest, significant cost to plan for. So, this total cost perspective shifts focus from monthly EMI to long term financial strategy. So, that is how the overall planning should be done. Then coming to impact of different variables. So, base case here of 60 lakhs, 8.5%, and then term is of 15 years. Monthly payment which it translates to is 59,094, and the total interest is 46.37 lakh. Scenario 1, we have a lower rate of 7 rate, scenario 1 lower rate to 7.5%. Payment drops to 55,638, interest to 40.15 lakh, saving 6.22 lakhs, again game changer for Indian borrowers. Then we have scenario 2, longer term to 25 years, right? Payment falls to 48,354, but interest soars to 85.06 lakhs, doubling the cost. Then we have another scenario where we are going for 80 lakhs loan, payment rises to 78,792 and interest to 61,082 lakhs. These variation highlight strategic choices like negotiating a 7.5% rate with SBI. In lecture which we discussed earlier, we compared loan cost for fixed versus ARMs. Here we are quantifying rate and term impacts. So, for Mumbai loan, 1% rate cut could fund a child's education. So, that kind of difference it can be. So, that is there. But there is a interesting question which comes to mind, and I hope you will think about it. Why does a longer term increase uh, total interest despite lower payments? I will repeat. Why does a longer term increase total interest despite lower payments? And the idea which I think you might already be having in your mind, but that would be consider the time value of money. So, coming to strategic debt management. Now, prepayment we understand can be a strategic debt management tool. We have discussed that earlier, that prepayment is a powerful tool. Prepayment involves paying more than the required EMI to reduce principal faster. So, leveraging RBI's no penalty rule for adjustable rate mortgages, as discussed earlier, benefits include significant interest saving, right? Shorter loan terms and guaranteed returns matching the mortgage rate, unlike volatile investments. So, in lecture earlier where we discussed covered product specific prepayment rules, like 1 to 2% penalties for fixed rate loan. But today we are trying to quantify savings for fixed rate scenarios, complementing those insights. Okay. So, for example, prepaying a Bangalore home loan saves lakhs, appealing to India's debt averse culture. Now, this strategy aligns with current competitive rates where borrower seeks early debt freedom. So, prepayments are like investing a 8.5% risk free, a compelling choice, right? Now, another question comes in mind: why might a fixed rate borrower prepay despite penalties? That can also be a case, right? That can also be a case that even though there is a penalty, despite that, fixed rate borrower may prepay penalties. And if you will think about it, there is a uh, suggestion: consider the long term saving versus penalty cost. Consider the long term saving versus penalty cost. Then we move to prepayment calculation examples. Here, let's quantify monthly prepayment for our 60 lakh loan, right? So, original term 59,094 monthly for 15 years, okay. 46.37 lakhs interest, adding 5,000 monthly. The new monthly payment is 64,094, reducing the term to approximately 12.3 years, saving 2.7 years and interest to 36.47 lakhs, saving 9.90 lakhs. This yields an 8.5% guaranteed return on the extra 5,000 far safer than the stock market. So, earlier we discussed prepayment strategies for ARMs and PMAY. Here we are trying to focus on fixed rate savings, avoiding overlap. For example, A Mumbai salaried professional prepaying 5,000 monthly achieves debt freedom faster. This saving is equivalent to earning 10 lakh free tax, earning 10 lakh tax free over 12 years, right? So, you can compare it to any person availing loan at 9%. So, saving would be slightly higher due to costlier interest. Okay. So, you can think about this, how 5,000 monthly saves nearly 10 lakh. Think about compound effect on the principal, right? I gave you a number, but think about it, that how you are coming up with that number. Idea is that saving of 5,000, you should look at it with the prism of compound effect, and then you will realize what I am trying to say here. Then we go for lump sum prepayment impact. So, now let us look at it. So, after 5 years, our 60 lakh loan has a balance of this, which is remaining. A 5 lakh prepayment reduces the balance to this with 10-year remaining, right? A 5 lakh prepayment reducing to this, shorting the term by 1.1 years and saving 1,84,996 in interest. Early prepayment maximize saving because interest accrue on a smaller balance longer, a key insight for Indian borrowers. So, in the past lecture, we noted prepayment timing's importance. Here we are trying to quantify its impact for fixed rate loan, right? So, that is what we are achieving here. Then going to the Excel formulas for mortgage calculation. So, here you can have some practical tools you can use. So, these are some methods. So, for example, monthly payment, you can use this equal to PMT 8.5% 12, 15 into 12 minus 60 lakh. So, result will get you 59,094. So, instead of doing it manually, you can use this Excel formula and quickly find out. So, Excel is very advantageous in that. Then interest for specific month. So, IPMT, use this formula 8.5% divided by 12, 1, 15 into 2 minus 60. So, we get result month 1 interest. Principal for specific month, we can use PPMT, this formula, and remaining balance after payments. So, this also we can use PV and bracket all this, and then we can quickly find out the balance. So, this type of Excel formulas can be very quick mode to calculate the numbers, right. So, earlier we tried to calculate EMI manually. Excel automates and reduces error. So, you should be aware of this also, that these simple Excel formulas can help you in quickly finding out the calculations, right. So, you can quickly see the scenario, what are the rate changes, and there is also possibility of speed and accuracy in Excel, which might not be there in the manual method. So, this kind of formulas may also be used by you. Then prepayment decision framework. So, when should you prepay versus invest, right? Favor prepayment when the mortgage rate, example 8.5% exceeds expected investment return. You prioritize guaranteed savings, seek debt free peace of mind, or have adequate emergency funds. Invest instead when expected return, example 12% equity markets, right, exceed the rate you need liquidity for opportunities, tax benefit under section 24B are significant, or you are comfortable with risk. Okay, so to understand, example, a Mumbai investor might invest in Nifty 50 at 12% rather than prepay at 8.5% loan. So there can be such scenarios also where you are looking for alternative investment to reduce your, not reduce, but actually to help you out in saving or creating a more uh, creating more wealth for you. So for example, we have seen that somebody choosing equity over prepaying their loan. So here we are trying to provide a decision framework considering what is currently prevailing in the market. Okay. Here we also have to consider that tax deduction up to 2 lakhs on interest makes loan attractive, but prepaying saves guaranteed interest, right? Prepaying saves guaranteed interest. So you have to take that into also account that 2 lakhs, there is a deduction up to 2 lakhs available on interest payment, but you also have a situation that if you prepay, you save on guaranteed interest. So a professional might prepay for stability, while an entrepreneur may invest. So it is also depending on your risk taking capabilities. Then we move to real estate investment context. So how do amortization and calculations impact investment? Right. So consider a 75 lakh Bangalore rental property with the 45,000 monthly rent and 59,000, around 59,000 payment, yielding a negative cash flow of around 14,000 rupees. However, include month 1 16,596 principal pay down, tax deduction on interest is 42,498 in month 1 and potential 5% annual appreciation, 3.75 lakh yearly that we can achieve. So true return combines rent minus interest minus expenses plus principal pay down and appreciation, offering positive wealth building despite negative cash flow. So earlier when we discussed, we analyzed rental cost, right? Here we are integrating amortization for holistic view. So for example, a person in Lucknow rental builds 2 lakh equity annually early on, right? So that can be also done. So this perspective shift focus from cash flow to long term gain, right, which can be common in India's appreciating markets. Then we move to common calculation mistakes. So let's steer clear of these errors. Now first one is using the annual rate 8.5% instead of monthly. We discussed this that sometimes this error is made and it should not be done, but we sometimes do see that. Here is one example of PMT calculation where 8.5% rate is directly taken, and if the correct process would be 8.5 divided by 12 equal to 0.7083% monthly rate. So that will be the correct method. Then forgetting the compounding effect. So small rate differences compound dramatically over time. So 7.5% versus 8.5 is equal to 6.22 lakh difference over 15 years. So that kind of difference can be there in the compounding effect. If you are not consider the compounding effect, you are making a big mistake. Then mistake 3, focusing solely on monthly payment, missing the bigger picture of total interest, right. So, for example, you are missing the 46.37 lakh interest cost, right. So, that you have to take into account. Mistake 4, let prepayment save less than the early ones due to lower interest impact. Late prepayment saves less than early ones due to lower interest impact, right. Early payment saves much more than the later one. So, please remember that year 1 prepayment versus year 10 prepayment impact will be significant, right. So, we emphasized earlier that monthly rates, and here we are highlighting pitfalls to ensure the accuracy. Okay. And this can happen that borrower may misuse annual rates and overpay significantly. So, these mistakes are common in India's complex mortgage markets, and we have to keep these things in mind. Then coming to technological tools for calculations. So, technological tools, technology basically simplify mortgage analysis. So, Excel and Google Sheets provide financial functions. We have seen earlier how to use Excel formulas. Then custom amortization tables, they are available online, you can find them, you can create on your own. And scenario analysis capabilities, which are there in Excel, much more easier to do. That is the envelope of plus minus percentages. Then online calculators offer EMI, prepayment and loan comparison tools. Mobile app track payments and send reminders, and professional software models complex scenarios for developer. So, in earlier lecture we used manual calculations. Technology reduce errors and save time. So, for example, HDFC EMI calculator helps Bangalore buyers compare loans. Apps like Bajaj Finance can track loans of a IT professional in real time. So, these tools are critical and can be very useful for our purpose. Then we go to different mortgage types and calculations. So, fixed rate mortgages like 60 lakh example we had taken, use consistent PMT calculations for predictable schedule. Variable rate mortgages, which are your ARMs, recalculate payments when rate changes, complicating amortization and requiring scenarios planning. Interest only mortgage pay only interest initially with higher principal payment later. So, earlier we saw rate adjustments, ARM rate adjustment, how they happen. Here we are trying to focus on their calculation complexity, right. For example, a Mumbai ARM at somebody in Mumbai, they have taken ARM at 8.5%, but that because it is flexible, it might jump to 9.5%, altering the EMIs per month. These variation affect budgeting, and especially in India's rate environment, they can be very, very difficult to gauge, right. So, that is there interest only mortgages, variable rate mortgages and fixed rate mortgages. Then commercial versus residential calculations. So, commercial and residential mortgages differ significantly. We have understood the commercial earlier that we have seen. So, again I will emphasize this and I will take one example also. So, first residential mortgages, there is a longer term of 15 to 30 years. Lenders feel much more confident in this aspect. They are provide better longer terms for residential mortgages in comparison to commercial, where they might be offering at max 10 years period. Then lower interest rate for residential mortgages in comparison to commercial mortgages, and simpler payment schedule for residential in comparison to commercial mortgages. And commercial often also require balloon payments to be done. And example which we have here is that a 2 crore commercial property term will be around 10 years, rate will be 11%, and monthly payment will come out to be 2,75,528. And sometimes in this situation, balloon payment is often required, especially at the maturity of the loan. So, lecture 12, earlier we introduced the commercial metrics like DSCR. Here we are trying to highlight the calculation differences. Okay. So, cultural and market context. So, if we understand this difference, so traditional approach would be preference for short term loans, shorter loan terms, higher down payments, and focus on debt free ownership, right. Modern trends would be acceptance of longer term financing, understanding of leverage benefits, and tax planning integration, right. And current market rates, home loans of around 8.5% to 11%, commercial loans of 10 to 14%, and variation based on the credit profile. So, this variation which is there, this bracket which is there, depends on lot of factors we have discussed earlier. I will briefly summarize those factors. So, we have seen that the CIBIL score makes a very important denomination. Sometimes that impacts your this percentage which you are talking about. Commercial loans, the rent, the how much rent, and how stable the business is. So, that will impact this. Also, there are lot of documentations required in commercial loans. So, that will also have to be seen. So, this is basically leading to variation which we can see. Then let us have a practical exercise framework here. So, step by step approach. Given any mortgage scenarios, identify the parameters: principal amount first, interest rate, convert to monthly, then terms in years, convert to months. Second will be calculate monthly payment, use PMT formula or Excel function. So, we have seen different Excel functions, or if you are comfortable doing manually, then you can use manual, but I would suggest that Excel function is a better and more reliable method. So, use that to calculate your monthly payments. Verify reasonableness, which is which is something which you can afford. Sometimes it happens that it might seem logical in theory, but in practical, when you compare it with your own salary and how much you are saving per month, so that becomes the issue, and your own understanding of the situation is the best one. So, reasonableness should also be there. Then analyze first few payments, calculate interest and principal portion. First few payments are important, calculate their interest and principal portions. Observe the pattern, what is happening, observe that. and evaluate prepayment options. So, also think about when you will be prepaying your loan. So, model different scenarios, create different scenarios, and you have that option available. You have different online tools available to you, and you can use those tools to create models of different scenarios, and then calculate time and interest saving. So, how much time and interest saving will be done through prepayment, that option you can identify. So, it's not a fixed process, fixed mm, method that you can just decide on. Basically, it depends a lot on what you are comfortable with. So, there is a maths, but then there is your own savings and your own finances. So, that basically will help you take the final decision of deciding for what kind of EMI you have to go with, and uh, what will be the time frame, and of course, what will be the prepayment option for you, or it will not be there, or like if it is there, when you will try to do it. So, you will have to take into account your own savings and everything, and then decide. Then we will go to certain advanced concepts. So, refinancing decision, right? Refinancing assesses when lower rate justify cost, right? So, using break even analysis, we have seen saving divided by closing cost, that you can take. Then ARM calculations, including index, example RBI repo rate, margin rate, caps, and payment shock risk. And we have reverse mortgages for senior debt. Debt grows as payment are received, unlike traditional loans. So, earlier we discussed ARM structures. Here we are highlighting their calculation challenges. For example, refinancing a Mumbai, like somebody has taken loan in Mumbai from for 9.5 for 9% to 7.5%, saves 5 lakh, but cost is 50,000 upfront. Reverse mortgage suits somebody who is elder, homeowner, and needing income. So, these concepts prepare for complex scenarios which can happen in current situations, right? So, not everything can be applicable to everyone. There has to be proper decision framework, and generally it is advisable that when you are taking such huge uh, money decisions, you should go for advisors, financial advisors. Then going with integration with investment analysis. So, mortgage calculations are vital for property evaluation. Cash flow is one of that. So, net operating income minus debt service, mortgage payment equals before tax cash flow. Return will be calculate cash on cash, that is cash flow divided by equity invested, and internal rate of return factoring leverage. So, risk will be assess debt service coverage ratio DSCR, loan to value ratios, and sensitivity to rate or rent changes. In earlier lecture, we used DSCR for commercial properties. Here we are trying to apply it to residential investment. For example, a Bangalore rental with 50,000 NOI and 58,000 to 38 payment has negative cash flow, but positive IRR with appreciation. So, leverage amplifies return but increases risk, a key insight for any Indian investor, right. So, this way also you can look at these scenarios. Then key formula summaries. So, here we can see monthly payment PMT. PMT is equal to P into a formula which we have seen earlier. Then monthly interest, interest is equal to beginning balance into monthly rate. Monthly principal, principal is equal to monthly payment minus interest, and then remaining balance will be new balance is equal to previous balance minus principal payment, and total interest is equal to monthly payment into number of payments, that is total, and that will be subtracted with from it principal will be subtracted. So, we are trying to consolidate all the calculations. We are trying to show here that all the formulas are important. These formulas analyze any home loan or rental investment, and these can become the backbone of your mortgage analysis in the current scenarios. Then we move to professional application. So, real estate professionals rely on these calculations. Agents help client assess the affordability. They can help in comparing loan scenarios and explain long term cost. So, mortgage broker structure optimal packages, compare lenders and advise on prepayments. Investors evaluate returns, optimize leverage and plan cash flow. Developer analyze construction and permanent financing. So, we are focusing on calculation driven roles. For example, a broker uses PMT to tailor Mumbai home loans, right. So, professional is using that PMT formula we have seen earlier and using Excel to come up with different scenarios and then advising their client. So, these skills build trust and expertise in India's competitive current scenarios. Then we come to regulatory and compliance aspects. So, lender must disclose the annual percentage rate APR, total interest over long life, monthly payment amounts and prepayment penalty terms. So, that should be disclosed completely so that there is no confusion in the mind of borrower, right. Then what are the safeguards, consumer protection safeguards? So, for that, Truth in Lending Act requirements, whatever is being whatever there is should be in the fine print. Good faith estimate provisions, right. Provision should be in good faith and ensure the clarity of whatever is there, and of course, right to prepay without penalty in many cases, right to prepay without penalty in general cases, right. Now, one thing which I would suggest you here is that many times we have seen that this there is when we are deciding on this arrangement of loan between the lender and borrower. So, borrowers generally do not read fine print in detail. So, that fine print should be read in detail so that every eventuality is clear to you. You should be very clear of the provisions under which loan have been given to you, so that in future there is no confusion. And as per the rules and processes, the lending agency has to completely explain all the rules which are there for the loan which they have given. So, it cannot be extracting, everything has to be transparent. And in case you have any doubt, you can or you should definitely ask them and make a clarification on it. Then coming to the case study. So, let us apply are skills to a rental property. An 80 lakh Mumbai property with 16 lakh down payment has 64 lakh loan at 10% for 25 years, yielding 50,000 monthly rent. Monthly payment is 58,238, resulting in negative cash flow. Month 1 principal is 4,905 with annual pay down of 60,000, growing yearly. Despite negative cash flow, equity build-up and 5% appreciation, that is 4 lakh yearly, creates positive returns. So, earlier we discussed and compared rental cost. Here we are trying to quantify the investment return, right. So, here we are trying to quantify the investment return, and we can see that annual principal pay down is 60,000, growing each year. Then coming to the future trends in mortgage calculations. So, artificial intelligence, of course, optimizes payment schedules. You can use that. AI is getting used everywhere. So, in this area also it can help you optimize the payment schedule, personalize payment plans and enhance risk assessment. Blockchain enables smart contract, right, and transparent calculations and lower cost. Green financing offers lower rate for sustainable properties like LEED certified office buildings. And earlier we noted that digital platforms, here we are trying to focus on calculation innovations. For example, AI driven app tailors prepayment for somebody who has taken a loan and saving them lakhs. Blockchain could streamline SBI's loan processing and reducing the fees of process. So, these trends align with what we are witnessing right now and may actually speeden up with the improvement in technology, right. Then we come to conclusion. So, essential concept to remember, the basic formula we have seen of EMIs or formula or PMT formula. Then we have seen the amortization payment, interest heavy early, principal heavy later. Then we have seen prepayment impact, that when you are deciding to pay your or do your prepayment, whether you are trying to do it on first year itself or in 10th year, that impacts the overall amount. So, very important decision. Then total cost awareness, focus beyond just monthly payments. Longer term loan of 30 years may reduce your EMI, but overall in total you will be paying a lot more in comparison to somebody who is paying for a shorter term loan. Technology tools, instead of using manual calculation, you can go for Excel. We have discussed the different Excel functions which you can utilize for your purpose. Investment context, consider mortgage calculation in broader financial strategy, not just loan paying, but also whether you have alternative investment options available with you or not, you can go with that also. And the strategic perspective, understand mortgage calculations, empower better financial decisions in real estate investment and your personal wealth building. So, practice calculation with different scenarios, set up Excel templates for quick analysis, explore online mortgage calculators. Professional development also you should seek, learn advanced Excel financial functions, understand local market rate variation, develop client counseling skills and investment planning, apply calculation to property evaluation, consider different financing strategies and integrate with portfolio planning. Thank you so much.